Hi guys and welcome to my YouTube channel. My name is Swatanda Rasiweda, and in this video I'll be talking about the similarities and the differences of unit trust and ETFs. So I've spoken about both unit trust and ETFs on my channel, and I just thought since there are a lot of similarities between them, let me also bring about the differences and just to highlight how similar they are as well. So if you go to your Easy Equities account and the tax-free savings account, you will see both unit trust and you will see ETFs. So when you know how they're different and you know how they're similar, then you know how to decide, right? Because we want to make informed decisions when we do invest. Okay. So before I can go, have you subscribed? I almost forgot, guys. Please subscribe. I am on the road to 5,000 subscribers. So if you are new to this channel, please make sure you subscribe. I like it when you view and you also press the subscribe button. It helps. It really helps a lot, because I wouldn't even be here if it wasn't for the motivation I get from people who are subscribing. Okay. Also, if you're a returning subscriber, feel welcome. Let's continue to learn together. I cannot do this on my own. I mean, I keep on learning new things every day, and hopefully I'll get to share all of it through the videos. Okay, so getting into it, the first similarity between the two is that they are both highly regulated, and this simply means that they cannot just invest as they go. There are things which are put in place to minimize the risk exposure they can, expose people into the different investments that are out there, especially for unit trust. So you will have something like Regulation 28, which limits ETFs and unit trust that invest for pensioners to not exceed 45% on offshore investments. Okay, so you have such things. These people follow standards. Okay, and the liquid, their liquidity is the same. I think the accessibility of money from your investment account is the same. Most of them are managed by the same company, so it's the same. Probably 2 to 5 working days you'll get your money. Transparency, they all have what is called a fact sheet, and I think this is my favorite part, because a fact sheet will tell you all the information that as an investor you need to know to make an investment decision. You can get past performance, you can get management fee or total expense ratio, you can get underlying asset classes, you can get more details about the objective of the fund. So I love the transparency there. And easy of access, you can find it anywhere. There's so many companies that provides both ETFs and unit trust. I mean, for unit trust, there's like your Allen Gray, your Investec, your Sanlam, your Coronation, your Old Mutuals. So there are so many companies out there, and you can do it online without going to their branches. Similarly to ETFs, there's like your Cetrix, your Corshare, your Signia, your APSA, your One Invest. So there's so many suppliers or providers of ETFs as well. And if you go online and Google these companies, you can buy them online without going to their offices. However, I find it easier to always use Easy Equities, because you can find both unit trust and Easy Equities of all the companies I've mentioned. Okay, I know for unit trust they're not as many, but for ETFs they are. Okay, and lastly, the low cost, right? And low cost is per unit or per ETF, right? So divided the whole fund, you get, a unit or an ETF. And the prices of those are normally lower than that of an individual share. For example, let's say you want to buy a Capitec share, you're most likely to pay something like 2,100. I'm not sure how much the price is today, but it's around that price, right? Which is too much for one share. Okay, but if you want to buy your top 40, you can get it around less than 100 rand. Okay, so they are a little bit more cheaper and give you broader exposure. And when it comes to the differences, one differencing, the differentiating factor is the pricing frequency. Like for unit trust, they are not listed on the JSE stock exchange or on the stock market, sorry. And when it comes to ETFs, they are listed on stock exchange. Even if it's not JSE, they are listed on the stock exchange. They trade on when the stock exchange opens. and you can see the fluctuation of price throughout the day. You can see prices going up, prices going down throughout the day. Where else on unit trust, the price is consolidated at the end of the day, so you will not see the price going up and down through the rest of the day. And that's the pricing frequency plus the listing. The second one is product availability. So there's something which is called the volume of trade. So unit trust have a huge volume of trade than unit trust, and mostly it's because they are listed, right? So if you want ETFs, you can get them, you can sell them at any time. But if you want unit trust, you're most likely to sell at the end of the day. If you issue your sell during the day, it will only be executed at the end of the day. Okay. And then in terms of cost, this is management cost. So it's another differentiating factor that unit trusts are actually more expensive because they are actively managed, and ETFs are cheaper because they are passively managed. And the difference is simply that on the unit trust side, the manager makes the decision to go and consolidate all the asset classes that should be within the unit trust and manage them as they go. Whereas on unit trust just follow an index, and then the manager can just do the review on a quarterly basis to make adjustment or rebalancing. On the unit trust as well, the manager, besides deciding what underlying asset classes should be there, they also like trading actively on it. Okay, so the performance as well is also different. Like there is a conversation out there that says actively managed accounts are not performing well, but you would expect an account that is actively managed to do better, right? However, you can go and check and compare how unit trusts have been performing versus ETFs. But if an account is actively managed, you would expect it to do better. But actively managed accounts have a reputation of not being performing well, right? Because obviously their goal, if it's being actively managed, is to beat the market. So yeah, that's it, guys. Yes, there's a point that I wanted to say, man, that slipped my mind. It is the fact that there are unit trusts that follow indexes. There are unit trusts that don't, and then they just, they are consolidation of mixed asset classes, like your commodity, your bond, your property, your cash. Yeah, so unit trust can be a consolidation of different asset classes, and where else ETFs are mainly a consolidation of shares. You can find that they have shares in properties, but it's mainly a consolidation of shares. I hope that brings you a bit of insights in regards to what the difference and how the similarities are between ETFs and unit trust and how you can use them. Okay, goodbye.